mortgage rates are rising again. We've recently seen mortgage rates pass the 7% mark, and now they're creeping back towards 8%, which means if you want to go out and buy a home, you're going to have to pay more money on your interest. By the end of this video, not only are you going to understand the real reason as to why mortgage rates are going up, but you're going to understand how to best protect yourself as somebody who maybe wants to buy a home or is thinking about selling their home. So let me start by talking about why mortgage rates are going up and the cost of these higher interest rates. Let's assume that you want to go out and buy this $500,000 home, but you want to put down 20%, so you're going to borrow $400,000. Now, to understand the real cost of the higher interest rates, let's assume that you're going to borrow this $400,000 at 6.5%. If you're going to borrow this $400,000 at 6.5%, that means your monthly mortgage payments are going to be $2,528 a month to borrow $400,000 at 6.5%. But if you borrow that same $400,000 at 7.5% instead of 6.5%, now it's going to cost you $2,797 a month for the exact same amount of money because you have to pay a higher interest rate. That's an additional $269 a month, or an additional $3,228 a year, or an additional $96,000 that you're going to be paying over the course of the 30 years of your mortgage, all because of that one little interest rate. These higher interest rates have made buying a home less affordable because now you have to pay more money in interest to borrow the same amount of dollars. But this is where now some home sellers have begun to get a little bit crafty, more specifically the home builders. Because what we're seeing a lot now is called a mortgage buy down, where essentially builders are working to pay down some of your mortgage. That way you can save some of this money in your pocket. And I want to talk about that before we jump into why mortgage rates are rising. So the plan for today, just so we're on the same page, is number one, I want to talk about mortgage buy downs because they've been growing a lot in popularity. Number two is I want to talk about why mortgage rates are rising today. And number three is I want to talk about what all of this means for you. So let's start by talking about mortgage buy downs, but I want to give you a little notice beforehand, which is that on May 21st, this month at 8 p.m. Eastern Time, I'm hosting a stock market mastery workshop where I'm going to be going over how you can invest your money in the stock market and how I am investing my money in the stock market. This is going to be a workshop for any of you who are interested in investing your money in the stock market and want to get a better understanding of how do you invest your money the right way, whether it be investing your money passively into funds, ETFs, mutual funds, index funds, or invest in individual companies and want to understand how do you find an undervalued stock. This is a completely free workshop, so if you'd like to join me, I got the link to how you can register for this workshop down in the description below. The way a mortgage buy down works is it's generally a new construction home where a home seller, the developer here, will say, sure, you want to buy a $500,000 home? Great. We will sell you this $500,000 home. And in addition to that, what we will do to incentivize you to buy our home is we will pay to buy down your mortgage. We will pay to get you a 6.5% mortgage instead of a 7.5% mortgage. And we will pay for this out of our own pocket, out of our own profits. Now, there are two different general types of mortgage buy downs that you're seeing happen through these new construction homes. One are temporary mortgage buy downs and the other are permanent mortgage buy downs. The way a temporary mortgage buy down works is, let's assume right now that the market rate for a 30-year mortgage is 7.5%. But the first year of your mortgage, instead of paying 7.5%, you pay 4.5%. Year two, you pay 5.5%. Year three, you pay 6.5%, and then year four, you pay 7.5%. A permanent mortgage buy down says that if you want to get a 30-year fixed rate mortgage, it's 7.5%, but because you're going to buy this home from me, this builder, I'm going to work to pay down your mortgage from 7.5% to now 6%. So even though the market is 7.5%, you only have to pay 6% in interest on your mortgage because me, the builder, I'm going to buy down this piece of your mortgage. Now, the thing that you want to understand about this mortgage buy down, like I said just a minute ago, is that builders are paying this mortgage buy down out of their own pocket, out of their own money. Now, you might be asking why. And I'll answer that in just a second, but before we do, let me show you actually the cost to builders. This is from John Burns, the consulting company, and it says that builders are contributing 5 to 6% of the home purchase price up front to lower the 30-year mortgage rate by 1 to 2%. That means if you're buying this $500,000 home, new construction from a builder, They might pay $30,000 out of their own profits to buy down your mortgage from 7.5% to 6.5% to incentivize you to buy the home. Now you might be saying, but Jaspreet, what if instead of me having them buy down my mortgage, I just ask them to take the 30% and lower the purchase price from $500,000 to $470,000? And there's two things I want you to understand about that. Number one is, if you are a financially savvy person and you want to pay down your mortgage early, that is a great idea because now you have less principal to pay off. But the second thing you want to think about is that builders are probably not going to accept your offer. The situation in the housing market right now is this: the homes are less affordable today, and because homes are less affordable, builders are having a little bit of a tougher time selling their homes. Now, I know it is still a strong housing market. You still have a lot of buyers out there relative to the inventory, but it's not as hot as it was a couple of years ago. And so now builders have to incentivize some people to go out and buy their homes. And the difficulty that builders are facing is that, well, people sometimes don't want to pay these higher mortgage rates. And so to incentivize people to buy their homes, they're working to pay down your mortgages through their profits. Now you might be saying, well, why won't they just discount their properties? And the reason why is because of comparable sales, comps. Because now, if in their neighborhood, some of these homes are selling for $470,000 in new construction, what do you think the next buyer is going to say? They're going to say, wait, that home right there sold for $470,000. Why do you want to sell us this home for $500,000? Can't we get a discounted price? Builders who are building these new construction homes want to keep up home prices. They want to inflate home prices as much as possible because that means they're going to be able to sell their homes for top dollar. And that means they're also going to be able to refinance and pull cash out if they need to at top dollar. So builders don't want to lower the prices of their homes because that doesn't look good on paper. And if they're not able to sell their homes for top dollar, well, that's a really bad issue because that means they can't continue getting financing, and they want to make sure they can sell the next home to somebody else at a high price as well. And they're hoping the mortgage rates will fall. That way, eventually they won't have to keep doing these buy downs because then they can make bigger profits on the next deals. But in order for them to continue selling the homes for top dollar, they cannot discount the prices of their homes. Builders will rather eat up their profits to get that mortgage buy down because they want to maintain top price for the homes. That way they can continue to sell their future homes at even higher prices instead of discounting the price of the homes that they sell you today. And this brings me now to point number two. Now that we talked about what's going on with mortgage buy downs, I want you to understand number two, which is why are mortgage rates rising today in this economy? If you're trying to understand what moves mortgage rates, there are two factors that you have to pay attention to. Number one is the Federal Reserve Bank. They're the central bank in the United States, and they have the ability to move interest rates, not mortgage rates, but interest rates. And then you have treasury yields. And explain what that means. Let me start by talking about the Federal Reserve Bank. The Federal Reserve Bank has the ability to move interest rates, and these interest rates are the interest rates that banks pay when they borrow money or lend money to another bank. So you can kind of think of it like the wholesale price that banks have to pay to borrow money. When a bank has to pay money to borrow money, they then jack up that price, they jack up the wholesale price to give you the retail price, which is your mortgage rate. It's kind of like if you go to Walmart and you want to buy watermelons. Walmart is jacking up the wholesale price, the price they're getting from the manufacturer or the farmer, and then they're going to sell it to you at the retail price. It works the same way in the banking industry. And the entity that's in charge of this wholesale rate is the Federal Reserve Bank. Now, although they're called the Federal Reserve Bank, they're actually not a bank. You and I can't go there to deposit money. It's not a reserve because they're not sitting on any cash reserves, and they're not federal because, well, they're not a part of the government. But they have the ability to control interest rates. And one of the reasons why they've been working to raise interest rates is because inflation has been coming in hotter than expected. And because inflation is still hot, they have not begun cutting interest rates. Now, a lot of people are speculating as to when the Federal Reserve Bank is going to start cutting interest rates. But as of today, the Federal Reserve Bank has not begun cutting interest rates, and they haven't risen interest rates for a while either. So now, even though the Federal Reserve Bank hasn't cut or risen interest rates, they kind of kept interest rates the same for almost a year now. Why are mortgage rates continuing to move up now? Well, if it's not because of the Federal Reserve Bank, it has to be because of treasury yields. Now, this can get very technical and very tricky very quickly, but if you stick with me, you'll understand how this works. What a treasury is it's a loan to the government. The United States government spends money they don't have. They've been doing this for a long time. It's called a national deficit. And the way that the United States government funds this spending is by doing something called issuing treasuries. That means the United States government is sending out these applications for a loan. You can lend your money to the government. I can lend my money to the government. Banks can lend their money to the government. You can go out and lend money to the government by buying treasuries. Now, the interesting thing about these treasuries is they are backed by the United States government, which is the strongest economy in the world, backed by the strongest military in the world, backed by the strongest currency in the world, the United States dollar. the world's reserve currency. And so now, this treasury is known as a quote-unquote risk-free return. If you read any economics book, everyone will tell you that these treasuries are risk-free returns because you're lending your money to the safest and strongest entity in the world. I mean, you can compare lending your money to the United States government versus lending your money to your broke cousin Bunty. Who's going to be more likely to pay your money back? Well, your broke cousin Bunty has been trying business ideas for a long time and doesn't know how to manage his money, versus the government has a money printer through the Federal Reserve Bank to print money if they can't make enough money through taxes. So the United States government is considered a risk-free return because they've always paid back their bills, and they have the ability to pay back through taxes and through the money printer. Now, because it is a risk-free return, what you have to now understand is how these treasury yields will impact other returns. And what that means is, if I can get, let's just say, a 4% return by lending my money to the government, if I were to lend my money to you, I would want a higher return because the government is giving me a 4% return. And this is the same situation, the same dilemma that banks have to face, which is, well, if I'm going to lend my money to the government as the bank, I better get a higher return from you because you are a more risky investment than the bank. Because banks are in the business of lending money. That's their business. And now they're going to compare risk versus return. And as treasury yields go up, well, then the return you better give me has to go up as well because you are more risky than the United States government. And what we've been seeing happen, especially recently, is that treasury yields have been rising. And the reason why treasury yields have been rising is because people are concerned about the economy and inflation. The most recent economic data that we got is essentially saying that our economy grew slower than expected, and the inflation data says that inflation grew harder than expected. And because we got these pieces of information, people are more concerned about the economy and inflation, and because of that, they look at the United States government as a riskier investment because they're more concerned about inflation, they're concerned about the economy, and when you're concerned about an investment, you demand a higher return, right? Risk versus reward. Now, of course, everything is relative. The government is still safer than your broke cousin Bunty, but as you start to see these higher inflation numbers and slower economic numbers, investors will then want a higher return. And that's why recently, in 2024, we've been seeing treasury yields go up because investors have been demanding higher returns. You've been seeing less buyers for these yields, which have been pushing up the return, pushing up the interest rates on these treasury yields, which then naturally trickles down to the banking sector, because if treasury yields are going up, your mortgage rate's also going to go up because you are a more risky investment than the government. So now what does all this mean for you? Well, if you're thinking about buying a home, I want you to understand that if you want to go out and buy a home, that's fine. Just make sure you can afford it. And when I say afford it, that means you got to afford three things. Number one, I want you to afford the down payment. Number two, I want you to afford the monthly payment. And number three, I want you to afford the move-in costs. When it comes to the down payment, what I like to see is at a minimum 20% down. I know that's kind of unheard of in today's economy, but if you really want to be able to afford it, get the best interest rates, not have to pay PMI, and have some equity in your property, get 20% down. Number two, you want to afford the monthly costs. Now again, I have kind of an aggressive approach here where I don't want my monthly cost to be more than 25% of my take-home pay. Yes, take-home pay, not my gross pay, my actual take-home pay. Again, I want to be aggressive because I don't want this home to be something that doesn't allow me to go out and invest my money. I want this home to be something that I can afford. That way I can continue investing my money and continue building my wealth, because that wealth is going to allow me to be financially free. This home is not. And number three is you got to afford the moving costs, okay? If you're moving into a home, you got to understand, number one, it's expensive to hire movers. Number two, when you move in, you might want to make updates. You might want to update the kitchen. You might want to update the basement. That's also expensive. Make sure you budget that. And number three is if you got to buy furniture, budget for that. It is expensive. My wife and I recently did some furniture shopping, and wow, furniture prices have gone up a lot in the last few years. So make sure you budget these costs, and now you don't move into a home and then sink your finances into a big black hole because you don't understand how expensive it was to be a homeowner. I want you to understand these costs before you go in. That way, being a homeowner doesn't turn you into a broke person because you just wanted to own the home that you live in. If you remember back earlier in 2024, the Federal Reserve Bank said that they would be cutting interest rates by their May 1st meeting, which didn't happen. Maybe we're going to see another potential interest rate hike in the future. The former United States Treasury Secretary said, you have to take seriously the possibility that the next interest rate move will be upwards rather than downwards.